Thank you. It is a great pleasure to discuss the future of sustainability reporting today. Sustainability reporting has been identified as a very relevant topic in the agenda of the G20 under the Italian presidency, which assigns strong emphasis to climate-related themes. I would like to briefly elaborate on some of the open issues on sustainability reporting, in which we hope the G20 will foster progress, also in light of the interconnection that these issues have with the European regulatory agenda. Reporting on characteristics related to sustainability is fundamental for a comprehensive evaluation of companies and to allow them to access markets with credentials in terms of environmental, social, and governance factors. A complete and non-reversible shift towards sustainable finance cannot be driven only from the top, with the intervention of policymakers and legislators. It has to be fully shared by firms, investors, and market players. In recent years, we have been witnessing a growing appetite for financial products that incorporate sustainable finance criteria, that is, ESG factors. According to estimates by Morningstar, at the end of last year, investment in ESG financial products amounted to around $1.9 trillion on a global scale, a figure that has been constantly growing over the years. The available empirical evidence seems indeed to indicate that sustainability integrated portfolios can provide better risk-adjusted return to investors. This suggests that companies that operate according to ESG criteria not only are better able to assess the risks to which their businesses or activities are exposed, but also are likely to have a better access to external sources of funding. Therefore, sustainability is not only a fundamental objective to pursue in the interest of future generations. It also represents a relevant factor of success and competitiveness for companies and investors. However, we all know that markets need complete, verifiable, and comparable information to properly allocate resources. For ESG factors, the reliability and quality of information that are currently disclosed is still unsatisfactory. In addition, comparability is hindered by the heterogeneity in the disclosure frameworks adopted by firms across jurisdictions. Finally, lack of reliable and standardized information increases the opacity on sustainability disclosure and can thus exacerbate the phenomenon of greenwashing. Based on these considerations, the European Union has recently proposed to revise the non-financial reporting directive and broaden its scope. This is a timely and appropriate step in the right direction. Improving the transparency of companies on ESG factors will help investors assess how firms are performing in some key ESG areas, like managing the transition towards cleaner energy sources, how well they are addressing the pay gap, how they are internalizing the externalities that they produce, how they are complying with the regulatory framework. ESG factors should also be viewed in light of their impact on the long-term value creation for the firm, as well as their overall impact on society. In this way, ESG information will help to mitigate the short-term focus on immediate value maximization that hinders the pursuit of long-term sustainable growth. For these reasons, sustainability reporting is also at the core of our G20 Green Agenda, and in particular of the recently re-established Sustainable Finance Working Group. I will briefly touch upon some of the open issues which will be addressed in this context, given their relevance for both the global and the European agenda. Traditionally, financial disclosure has focused on information used to calculate the expected returns of investment, having mostly in mind the interests of investors. This type of accounting framework, labeled single materiality, has been expanded to include climate-related risks, since they typically translate into financial risks. While having a clear picture of risks stemming from the environment inward into companies' books and performance is essential to mobilize sustainable investment on a large scale, a second layer of relevant information pertains to the potential implication that the business activity can produce outwards on any dimension of sustainability, including climate. Double materiality that includes the two types of information, those related to firms' financial prospects and those related to firms' social footprint at large, goes to the benefit of a broader group of stakeholders, investors, but also consumers, civil society, employees, and policymakers. While non-financial reporting directive of the European Union already follows the double materiality approach, much of the international work on sustainability disclosure and reporting so far has focused on single materiality. The G20 is paying much attention to the need to overcome the dichotomy between single and double materiality. One of the three pillars of the Sustainable Finance Working Group is in this sustainable disclosure and reporting, also with the aim to promote a coherent framework that adequately represents both the enterprise value of corporations and the impact on ESG factors. A necessary precondition for an effective disclosure framework is the availability of high-quality data that feed into reliable and comparable indicators across jurisdictions. Also, on the issue of data gaps, the G20 has been very active. The Italian presidency has mandated the Financial Stability Board to produce a report on sustainability disclosure and climate data gaps and asked the International Monetary Fund to include climate issues in setting up a new data gap initiative. This initiative will be fundamental also to allow policymakers and regulators to make sound evaluation and decisions. Let me now turn to another sometimes misleading dichotomy in sustainability reporting, regional versus global. ESG risks, like capital markets, are rarely constrained by jurisdictional boundaries. Therefore, adequate solutions need a coordinated response. Only a set of common worldwide principles and standards can ensure the transparency needed by investors to compare options on a global scale and a harmonized development of capital markets. Many initiatives, like the one of the Alliance of Leading Sustainability Reporting Organizations, are aimed at fostering globally comparable disclosure in sustainability reporting. As G20 presidency, we welcome the IFRS Foundation proposal to establish a sustainability standard board that would build upon the established work of the Financial Stability Board Task Force on climate-related financial disclosures. It is important to stress that international standards represent a minimum obligation which should not prevent individual jurisdiction or region to top it up with additional requirements. This can as well include obligation in terms of broad and diverse sustainability impact reporting, like the one proposed by the Commission, covering also social aspects of sustainability. Positive competition between regional approaches need to be preserved, especially at this initial stage. Cooperation between global and regional initiatives should be fostered in a constructive spirit, with the aim of promoting convergence also in light of the delegated act that will complement the corporate sustainability reporting directive proposals. In this regard, it will be important that the IFRS Foundation accelerates its work to cover all ESG issues, not just climate, due to the relevance that the other factors are assuming. The third important issue on non-financial reporting that I would like to touch upon concerns the different entities that are subject to these obligations. This is critical for small and medium-sized enterprises in particular. SMEs are the backbone of many economies. They are the biggest contributor to total employment and job creation, especially among emerging countries. SMEs are also a key component of global value chains, as large companies rely on them to supply raw materials, goods and services. However, few SMEs are reporting on sustainability, mainly because disclosure has a cost. Yet, there is value in SMEs accounting for their sustainability risks and impacts, as the proposal of the Commission acknowledges. Reporting on key sustainability issues not only will make SMEs grow more aware of all the sustainability implications related to their activities, it will also make them more appealing for market-based finance that seems to have an appetite for ESG-compliant type of products. In the design of SMEs' reporting obligations, nevertheless, we need to take the operational aspects into account. Small organizations are unlikely to avail of sustainability knowledge and expertise in-house, which means that they may have to rely on external consultants, an often costly expense. At the G20 level, we are trying to identify best practices to foster corporate sustainability reporting of non-listed and SMEs. The Sustainable Finance Working Group will indeed focus on how SMEs are currently coping with sustainability reporting, including to what extent SMEs are subject to reporting requirements. This will allow to develop recommendations, policies, standards and tools on how to enhance SMEs' engagement in sustainability reporting. One possibility could be a mix between a top-down approach and a bottom-up approach. It would imply narrowing down the SMEs reporting to specific subsets of indicators and, at the same time, applying to large and listed companies reporting obligations that include disclosure on supply chain structure that would allow to retrieve information on SMEs indirectly. In any case, it would be paramount to adopt a gradual and proportionate approach through voluntary or opt-in mechanism to avoid unintended consequences. In conclusion, much has been done on climate-related financial risks and opportunities. We should keep pursuing this goal, also carefully designing the framework of non-financial reporting for smaller entities, with the aim of having the largest coverage of firms, while not imposing excessive compliance burden. In parallel, there is a growing interest to develop a coordinated broader reporting framework that includes a full range of sustainability-related issues. The European Union is again at the forefront of this debate, with the European Commission working on the design of a social taxonomy. Information on human rights, human capital, and workforce diversity should be incorporated in the European sustainability reporting standards. The experience of the pandemic has indeed shown how urgent it is to expand the scope of the sustainability discussion to encompass very relevant social issues, such as inequality and access to health. We should not lose momentum. The European Union has taken the lead on the fight against climate change, yet the sustainable transition cannot be achieved by one region alone. Hence, global cooperation is key, and we are glad to see a broad engagement towards our G20 Green Agenda. We intend to seize this unique opportunity to incorporate ESG criteria into our policies and set a fast track to future work in this field. Thank you very much.